Hey, I'm Jason, and this is Supply Demand Daily, where I tell you what we learned about the economy today. I have a couple of pieces of good data out from the Census Bureau here for you today. We're going to be looking at non-defense capital goods orders as well as durable goods orders from manufacturing companies, and that comes from the Census Bureau, and we're going to be looking at the month of April. There's a 1 month delay on this, just like most economic data, and then I'm going to say a few words about some Eastern and more recently Western European countries' plan to try and mitigate the current disaster that's going on with the global wheat and grain export trade. So a couple things to cover here, and I hope you enjoy it. I'm going to go ahead and get out of the way so I can show you what's going on. So non-defense capital goods. When you think about capital goods, just juxtapose them with consumer goods. So a consumer good is something like a microphone or a package of Oreos or the bags of coffee that I consume copious amounts of in order to keep myself alive and sane, somewhat sane. But anyway, so non-defense capital goods, what are we talking about when we say capital goods? We're talking about the kinds of materials and equipment that it takes to make other goods and not the inputs to those goods. So when we think about Oreos, we're not talking about the plastic that makes up the wrappers. What we're talking about are the machines that put the prepared sleeve of Oreos in through the machine and then wrap them in plastic. So that's a capital good, some kind of machine or even a component of a machine, because oftentimes these things need to be repaired and they're very expensive. A lot of machines that are used in production are expensive, and so they need to be repaired, and so parts are made just for those machines. Used to use a lot of things like that when I was a butcher working my way through college, but anyway, so that's what we mean when we talk about capital goods. I want to direct your attention first to the yellow line. This is in 2022 dollars, so completely inflated. All of the cost increases that have happened over the last year have made their way into these 2022 dollars, and that is how this indicator is reported. It's not reported in what we would call adjusted dollars or what we would call real dollars. It's reported in current dollars. And whenever somebody says current dollars, that just means sticker prices as of the day that they were recorded. Okay, so in 2022, if you look at sticker prices, then they're obviously going to have all of the general inflation within them that has been experienced over the last year, going back to about April of 2021. So that's the yellow line here, and we saw a little bit of growth, though basically a rounding error in the 2022 dollar and the current dollar reading of this particular indicator. We're looking at 0.1%. Okay, so 0.1%, and we're looking at this chart is in billions of dollars. Well, no, it's not. It's in millions of dollars. So if you take 70,000 times a million, then you get 70 billion. Okay, so we're looking at billions of dollars here on a monthly basis, and so when we talk about 0.1%, that's not a whole lot. But then when we look at 2019 dollars, so this blue line here is what happens when you take this data and then you adjust it. If you basically take the simulation of if all of these readings were in dollars of 2019 or in 2019 prices, then we're looking at a different situation. And this would be true. I played with a couple of different base years here, and this would be true whether you did 2019 dollars or 2012 dollars or 1998 dollars or whatever. And by the way, this chart goes all the way back to 2017. It's 5 years of data. So this would be true no matter what base year you use. But what I wanted to point out here is this inflation gap is continuing to rise. So on a nominal or a current basis, as it's called, we don't see a decrease in these numbers, but then on the inflation adjusted basis, we can clearly see that for all of these capital goods that are being purchased, the manufacturers that are purchasing them might be spending more, but that doesn't necessarily mean that they're ordering more capital goods. And so this is really what we care about when it comes to, trying to evaluate the trajectory of economic growth or see if the human standard of living within the United States, as this particular indicator is concerned, is going to increase or decrease. So I have a similar theme here for you on the durable goods orders. So when you think about durable goods, and these are orders that are being shipped out from manufacturers, okay? So the way that most supply chains work is you have the manufacturer who actually makes the thing, and then oftentimes you'll have a couple of different steps in between them and the consumer. There could be a wholesale distributor, and then there could be a retail distributor after that, or there may just be a big retail distributor like maybe Walmart or Best Buy or Lowe's or whatever. Okay, so when we look at durable goods orders, we're looking at orders of things like dishwashers and washing machines, and I think even cars are considered a durable good, but microwaves and those kinds of things. So goods that you use for, I think the official definition of a durable good economically, if I remember correctly, is something that you use for more than 3 years. I think that's what a durable good is considered. I have to maybe check back up on that, but that's what we're talking about when we think about durable goods. And these are orders from the retailer or from the wholesale distributor to the manufacturer, okay? Or what the manufacturer is going to ship to those downstream distributors. And so this is kind of giving us a forward-looking lens or a forward-looking glimpse at what those companies who have to sit on inventory and then distribute it to their customers on the kind of demand that they're expecting. Okay, so that's why I like to look at these different things, but. In the yellow line, again, we have unadjusted 2022 dollars or current dollars. These are orders at current prices. And we see this inflation gap is even quite a bit larger than the last chart that we saw. So, and you can see that it's been growing since about, when? April of 2021, just like we mentioned a minute ago. And then, so we see the same thing with this blue line. These are the values of these durable goods orders at 2019 prices, and they pretty much seem to have hit their top and seem to be headed the other way. The other thing that I wanted to point out about this chart for durable goods orders is that if you pay attention to the blue line, there actually hasn't been a real improvement ever since 2018, which actually corresponds to the, before the COVID-19 pandemic, the most recent top in the stock market, as well as the top in bond yields and a lot of other different financial indicators that went pretty pessimistic throughout the year of 2019. And if you remember, that was the year of the so-called Powell pivot, when the Federal Reserve was raising rates, and then because the economy sort of showed signs of weakness, they did the opposite and started cutting again. So durable goods orders down by about 1%, so 0.9, and then in current dollars they were up by sort of a paltry 0.5%. So not amazing there. Now, the deal that's happening in Ukraine, if you haven't been following this news, the Russians have blockaded some major, at least as far as we know, the Russian Navy has blockaded some pretty major ports along the coast of Ukraine, and so one of those ports is Odessa. Now, they have not invaded Odessa necessarily, but they are still blockading that port. And as a result of that, there's about 4 million tons of grain that are sitting in silos in various Ukraine ports, Odessa probably being the largest one. And just some background, Ukraine does grow 12% of the world's wheat, and it grows 15% of the world's corn and supplies about half of the world's sunflower oil. So these are very consequential cash crops that Ukraine exports from its country. And because of the blockades, a lot of those commodities are not getting through and reaching the markets in which they would otherwise be sold. And so there are a few countries that have decided to, have floated the idea of maybe doing something about that. We have Lithuanian Foreign Minister on Monday of this week, Gabrielius Landsbergis. Yeah, I'm not great with foreign names, but there we go. Suggests using naval or airborne escorts for shipments of grain from Ukrainian ports Ports says Lithuania is seeking a coalition of the willing. Okay, so that was Monday, May 23rd. And then ever since then, there's been a couple of other leaders in Eastern as well as Western Europe who have kind of signed on to this idea. So Estonian President Karis said he had been pushing for some naval exports for grain freighters, but not everyone was convinced that this was a good idea, as it may escalate violence, conflict in the Black Sea. And then on May 25th, which was today, the Dutch defense minister, who goes by the name of Kaja Ollongren, said that they are willing, which I believe that is a he, said he is willing to join in on that type of effort. And then, but the one concern that's been floated about this is that if we look back at this map of the Black Sea, we have a couple of different countries that border it. The biggest powers being Moscow and Turkey. And so one concern that these countries have floated out there is that they will need guarantees from both Turkey and Russia that these escorts will not be, that these naval escorts or maybe possibly airborne escorts, but it does look like naval has been a greater subject of talk. So they will need guarantees that these accommodations, that these guard forces are not going to be attacked by the Russian Navy. And so this is a really interesting solution that I just wanted to point out, because it is coming from Eastern Europe, where most of the talk on the with the exception of the Dutch defense minister, which was just today, but a lot of these suggestions and the potential allies in this group have come out of Eastern Europe, which these countries are not usually as paid attention to as the France, the Germany, and the UK. These other European countries that tend to pull a lot more weight and hold a lot more weight in how decisions get made over there. But it's a really interesting solution. But the other reason that I wanted to point out is that, these countries are willing to do this sort of in lieu of trying to bring Russia and Ukraine to the table to try and negotiate some kind of peace agreement or negotiate some kind of ceasefire. So it's just very interesting how allergic everybody seems to be to ending this conflict, and they seem to be ready to ride it out until whatever the end looks like. I'm not sure what that is, but a curious and hopefully some sort of solution does come out of all of this, because wheat has gotten very expensive. So between May 2020 and basically the current day leading all the way up until the Russian invasion in late February, the price of wheat increased about 60% from an average of $500, not $500, from about $5 a bushel all the way up to $8 a bushel. And ever since the Russian invasion of Ukraine, as I mentioned before, wheat has been particularly sensitive to this foreign conflict. It went up another 50%, but by a greater dollar amount. So we went from $8 up to $12, and now we're at about $11.50. So these grain prices have been especially hurt or helped if you're one of the grain exporters or grain farmers who can actually get your crops out of your country. But these wheat crop prices have been especially impacted by the conflict, and I just wanted to show you just to what a magnitude that is. It is very, very disconcerting, and I do hope that these Eastern European countries can, like I said, the preferable situation would be to negotiate a ceasefire, and then you don't have to worry about the blockade. But if they can get Turkey and Russia to agree to some kind of security guarantee where they will not attack, which I don't know why they would, where they will not attack the escorts for these for these freighters, then that would be a decent situation as well. And then for tomorrow, what do we have coming up? It's Thursday, May 26th. We're going to look at initial jobless claims. As I mentioned, they were elevated for the 6th week in a row last week, and so I'm going to be looking to see if we see the 7th week of an elevated moving average. I've been looking at the 4-week moving average is what I'm referencing there. And we have the first revision for those nasty Q1 gross domestic product figures measuring how much stuff, how many goods and services were produced in the economy between January and March of 2022. That was negative on an inflation-adjusted basis, as we found out a few weeks ago. I think, or maybe it was 4 weeks ago. I'm not sure now. And then we have the pending home sales index, which is going to come out tomorrow. And the expectation, as the Wall Street survey of economic forecasters is concerned, is negative 2%, which would be pretty well in line with the housing data that we saw yesterday. But actually, it may be even worse, because if you remember from yesterday, we had, let's see, what was it? New home sales down 22% from month to month. So, and we'll see what happens there. It's going to be an interesting day. I'd like to thank you for joining me for today's Supply and Demand Daily. And if you like the show, then go ahead and subscribe to me on YouTube and leave a comment with any questions or suggestions, any topics that you would like to see covered. I'd love to hear your ideas. All right, take care. Have a good rest of your day.